Wars are scary. Headlines scream chaos. Markets dip. People panic. But here's the secret. Wars have a predictable pattern. Smart investors don't run away. They learn the rhythm and position themselves to win. Today, let's walk through how this pattern played out in past wars and how it's unfolding right now with the Iran conflict, during the fighting and after it ends. Let's go. Every major war follows the same 3 beats. Fear phase. Stocks drop fast, usually 5 to 6% on average, because uncertainty is scary. War boom phase. Certain sectors explode upward as governments spend big on necessities. Post-war boom phase. Rebuilding kicks in, and markets often recover stronger than before. History proves it over and over. The broad market might wobble, but smart money focuses on what wars need. Let's look at the greatest hits. World War II. Markets dipped at first, but then soared. The Dow ended up over 50% by the war's close. Why? Massive spending on planes, tanks, and ships. Defense companies boomed. Korean War. Stocks delivered double-digit gains. The market rose strongly as the conflict went on. Gulf War, 1990 to 91. Stocks fell about 10 to 15% when Iraq invaded Kuwait and oil spiked. But once the fighting started and ended quickly, the S&P 500 rallied over 20% in the following year. Iraq War, 2003. Similar story. Initial dip, then the S&P gained around 26% by year-end as things stabilized. Across dozens of conflicts since the 1920s, the average pattern holds. Short-term fear, then recovery in weeks to months. Stocks have often posted positive returns during the wars themselves, sometimes beating normal years. The winners? Defense and energy. Wars need weapons, missiles, jets, and drones, so companies like Lockheed, RTX, and Northrop Grumman get huge contracts and their stocks rise. Wars also need fuel. When supply lines get disrupted, like oil choke points, energy stocks surge. Gold often shines too as a safe haven when things feel wild. Now look at today's Iran conflict. Strikes began, the Strait of Hormuz, the world's key oil highway, faced disruption, and oil prices spiked sharply, hitting over $100 at points. Defense stocks jumped on new orders for missiles and defense systems. Energy companies rose with the oil surge. The broader market dipped at first, classic fear phase, but history says these dips are often short. Markets have recovered to pre-event levels in just a few weeks on average. Smart investors are watching exactly this pattern play out again. Necessity drives the boom while headlines scream panic. Here's where it gets really exciting. The post-war boom. Once fighting slows, rebuilding starts. Billions flow into roads, bridges, factories, refineries, and infrastructure. Materials like steel and copper take off. Engineering and industrial companies win big contracts. Broad markets often rebound even stronger because governments stimulate and pent-up demand explodes. Look at past examples. After the Gulf War and Iraq conflicts, stocks rallied hard in the following years as stability returned and rebuilding kicked in. The same cycle has repeated for decades. The fear creates the sale. Necessity creates the boom. Rebuilding creates the lasting gains. So how can you use this pattern? During the war, right now, focus on defense and energy sectors, or ETFs. Consider a bit of gold for protection. Stay diversified. Don't bet everything. For post-war, prepare for infrastructure, materials, and broad market recovery plays. Buy quality on dips instead of trying to time perfectly. Use small, regular investments so you catch both the cheap prices during fear and the upside later. Wars are tragic and unpredictable. Markets don't love them, but they follow this rhythm almost every time. History shows the smart move isn't panic. It's understanding the pattern and staying calm. Wars come and go, but the pattern repeats. Learn it, and you can navigate better. What do you think? Watching defense or energy now, or planning for the rebuild? Drop it in the comments. Important disclaimer. This is not financial advice. Investing involves risk. Wars are unpredictable. Past performance doesn't guarantee future results. Do your own research and consult a professional. Like if this helped, subscribe for more straightforward money stories, and I'll see you next time. Stay smart out there.